While determining the price, the last class I told you, that is when a company places an order to buy an aircraft. So what is the how it will calculate? You must have done net present value, IRR, etc. So suppose net present value. On the basis of that, Indigo will decide, that is what is the maximum amount it can pay for the aircrafts. What do you mean by this? Maximum amount it can pay for the aircrafts, because Indigo, once it buys the aircraft, it will use the aircraft for, it will include the aircrafts in its fleet, and it will start earning revenues from the aircraft. Now, one important thing to note here is these calculations are done much before than the date when it places the order. So when you are calculating what is the maximum price you can pay, at that time there is one exchange rate, and by the time you place the order, the exchange rate changes. Okay. Now when you are calculating or when you start negotiating, at that time you do not know whether you will place the order or not. Okay. Now in this case, Indigo knows that they are going to buy from Airbus. Suppose it is an airline company which uses both Boeing as well as Airbus, so it may not place the order to Airbus. If it places the order to Airbus, it has to pay in euro, but if it buys from Boeing, it has to pay in dollar. Okay. So when you are calculating all this, at that time, you actually cannot enter into a forward contract, knowing fully well that exchange rate will change by the time you place the order. So only thing what you can do, you can buy a call option at that time. So if you place the order, you keep the call option. If you do not place the order, you allow the contract to expire at its maturity. Your only loss will be the premium paid. Okay, that you cannot do with the forward contract or future contract. So that you will have to settle. So, however, the FEDI has given permission to all the traders in India, in which they can trade on the basis of 25% of the last 3 years turnover. But actually, what happens, and there are sometimes there are restrictions on this kind of transaction. But option has this advantage, that is, when you are negotiating and when you are negotiating with the counterparty, at that time you can buy an option. So your maximum loss is the premium which you are paying. Okay. So these are the advantages of option over other methods. Any question? Yeah, here one thing is clear. At forward, if you buy a forward contract, you have to buy at for 74.5. So if the price is more than 74.5, you have to buy at 74.5. Even if the price is less than 74.5, you have to buy at 74.5. Agreed? What about option? If the price is more than 74.5, you have the right to buy, so you exercise your right and buy at 74.5. But if the price is less than 74.5, what do? Will you buy?
No, sir.
So can I say that if the another thing, suppose price is 80, in forward you will be buying at 74.5, in option also you will be buying at 74.5, because forward you don't have a choice, you have to buy at 74.5. Option, you will exercise your right only when the price is more than 74.5. Okay. Option, you will exercise your right only when the price is more than 74.5. Okay. If the price is 80, you will exercise your right and buy at 74.5. But forward you are buying at 74.5 without paying any premium. Option, you are buying at 74.5 by paying premium. Make sense? Huh?
The premium removes the obligation, right?
Premium?
Compulsory buy. Removes the obligation to buy compulsory.
Right. Premium removes the obligation. Okay. So if the price is more, forward is better. Agree? I said if the price is more, forward is better. Agree?
Yes, sir.
If the price is less, option is better. Suppose price is 70. Forward you still buy at 74.5. Option you buy at 70. So there must be an exchange rate where both are equally profitable. At what exchange rate option and forward are equally profitable? Suppose at X exchange rate, forward and options are equally profitable. So if the exchange rate is X, how much money you get from option? 500 into X. But you paid a premium of 750, so your total cost is 500 into X plus 750. That must be equal to the amount which you are paying for option. It is forward, it is fixed 37,250. I repeat, if I assume that at X exchange rate both are equally profitable, how much you get from option? 500 into X plus what is the premium you paid? 750. That must be equal to forward contract 37,250. So from this X is equal to 73. So at 73 both are equally profitable. Above 73 forward profitable, below 73 option is profitable. Got it? Question, confusion? Any question? Go to the next one. It says, how can Interglobe Aviation Limited construct a currency collar? The word currency, another name of currency collar is range forward. The word collar came from when you tie a dog, there is a collar. The dog. Now, when you tie a dog, it cannot go beyond a particular range. So it came from that. So here also you are creating a range. How can you construct a currency collar? Interglobe Aviation Limited can construct a currency collar by buying a call option at a strike price of €1 is equal to 74.5 at a premium of 1.5, simultaneously selling a put option at a strike price of 72.5 at a premium of 0.8. Now here it will receive, when you sell a put option, you receive a premium. When you buy a call option, you pay a premium. So your net premium outgo will be 1.5 minus 0.8, that is 0.7 into 500, that is 350 million. So major reason for entering into a currency collar is reducing the premium. Okay. Why? Because when you buy a call option, your profit is unlimited, but your loss is limited. But when you write a put option, your profit is limited, loss is unlimited. So here, why should you restrict your price at 72.5? Because you want to reduce the premium. Okay. So what are the possible cases you can have? So 72.5 is the price at which you have bought the call option. You have written the put option, and 74.5 is the price at which you bought the call option. So what are the possible cases? Price may be less than 72.5, price may be more than 74.5. So less than or more than, if decision is same, I have taken only one. Yeah. So suppose after 1 year, €1 is equal to 72. What will happen to the call option? You have the right to buy, but you means Indigo bought a call option. So Indigo has the right to buy at 72.5. I repeat, Indigo has the right to buy at 72.5. Okay? Indigo has the right to buy at 72.5. Market price is 72. Will it buy at 72?
No, sir. It will buy at 72.
It will buy at 72. It will not buy at, sorry.
It will not exercise it.
It will not exercise, it's right, it will buy from the market. What about put option? That person has the right to sell at 74.5. Market price is, I'm sorry, making a mistake. Call is at 74.5, put is at 72.5. So Indigo has bought a call option at 74.5, market price is 72. It will not exercise this right. Indigo has written a put option at 72.5. So somebody must have bought a put option at 72.5. So if you buy a put option at 72.5, and if the market price is 72, you will definitely not exercise your right because you have the right to sell at 72.5. Market price is 72. So if you exercise your right, at what price you can sell? 72.5. And Indigo has sold the put option. That means Indigo has to buy 500 million euro at a price of 72.5. So this is the price. Yes or no? So buyer of the put option will exercise his right. If he exercises his right, Indigo has to buy at 72.5. Any question? If the price is 72.5, call option will not be exercised. Why? Why call option will not be exercised? Because Indigo has the right to buy at 74.5, whereas the market price is 72.5. So call option will not be exercised. What about put option? You have the whoever buys a put option at 72.5, he has the right to buy at 72.5. Market price is also 72.5. So if he exercises his right, he can sell at 72.5. If he does not exercise his right, sell it in the market for 72.5. So his decision is immaterial. So if he exercises his right, Indigo has to buy from him at 72.5. If he does not exercise his right, Indigo has to buy from market because Indigo actually has to buy 500 million euro at 72.5. So his decision is immaterial. If the price is 73, call option, you still do not exercise. Why? You have the right to sell, right to buy at 74.5. Market price is 73. So you will prefer to buy it from the market at a price of 73. What about put option? That person has the right to sell at 72.5. Market price is 73. So he will prefer to sell it in the market, not exercise his right. So if he does not exercise his right and you also do not exercise his right, then you have to buy it from the market at the prevailing market price, which is 73. So actual price Indigo is paying at 73. 74, same rule. Nobody exercises. So Indigo has to buy from the market at 74. If it is 74.5, Indigo's decision is immaterial. Why? If Indigo exercises his right, it can buy from the market. It can buy at 74.5. If it does not exercise his right, it can buy from the market at 74.5. His decision is immaterial. What about put option? He does not exercise. So Indigo has to buy at 74.5. If it is more than 74.5, say 75. Call option will be exercised. Why? Indigo has the right to buy at 74.5. Market price is 75. So Indigo will pay a higher price if it buys from the market. So naturally it will exercise its right and pay 74.5 to buy the euros. So 74.5. What about put option? Not exercised. Any question? So your upside profit was unlimited, but downside risk you are limiting by this one you are limiting by receiving a premium. So your entire premium outgo is premium outgo is coming down. So your here risk is restricted to 74.5, but you are also limiting your profit. By limiting your profit, you are also reducing your premium outgo. That is the major purpose of constructing a currency column. Any question? Anybody?
The put option is
Huh?
yeah. So the put option is there, right, in the first one. It is exercised by the other party, right?
The other part.
Okay. So then they are obliged to pay.
Indigo has written the option. So Indigo, if that person exercises his right, Indigo has to oblige. So it has the obligation. Got it?
Got it.
Next. Any question? Somebody else was asking. Yeah. So actually, how much money Indigo is paying to buy 500 million euro? Okay. Any question? So what is our next question? Last one, I believe. So currency collar is done. Assuming a neutral zone of 68. So how do you define this? This is called risk sharing. What is this risk sharing? Two companies, they will come together and enter into a contract where they will share the risk and reward on a suitable basis. Here we have assumed equally. So suppose they decide that there is a neutral zone of 68 and 74 and there is a base rate of 71. So what happens is within this neutral zone of 68 and 74 with a base rate of 71, Interglobe Aviation Limited will pay Airbus an amount equal to 500 into 71, that is 35,500 million. How do you get 500? 500 million euro is the contract price. Okay. And how do you get 71? This is decided by them, negotiated. So if after 1 year exchange rate is within this range of 68 and 74, Indigo will pay 35 an amount which will in rupee term which will be equal to 35,500. So if the exchange rate is 68, how much Indigo will pay? 35,500 divided by 68. If the exchange rate is 69, how much Indigo will pay? 35,500 divided by 69. Similarly, if it is 70, 35,500 divided by 70. 71, 35,500 divided by 71. 72, 35,500 divided by 72. 73, 35,500 divided by 73, and 74, 35,500 divided by 74. So maximum amount it will pay is 520. Maximum amount Airbus will receive is 522.06 million. Minimum amount it will be receiving is 479.73 million. So for Indigo, the amount payable is fixed at 35,500 million rupees. Any question up to this point? This range, base rate, these are all negotiated. Yeah.
So how do they, like, if it crosses right in that negotiation, it will be what would be there, sir, if it is out of the range?
Crosses beyond 68 and 74, that I have not told you. I will. But up to this, any question? Up to this, any question? Is this clear? Now, suppose it goes beyond the lower boundary or upper boundary of the neutral zone. So, one thing is clear. If the exchange rate falls below 68, so it is a profit. Why? Indigo can buy euro at a lower price. So, profit will be shared by them. Similarly, if exchange rate goes beyond 74, there is a loss. Loss will also be shared by them. So, that is what is called risk sharing. So, however, if the exchange rate after 1 year goes beyond the neutral zone, say euro 1 is equal to 66. My neutral zone was up to 68. So, there is a profit of 2 rupees. So, this 2 rupees of profit assuming shared by them equally. So, if it is shared by them equally, each gets 1 rupee 2 by 2. So, they will calculate a new base rate. How? 71 was the old base rate minus 2 by 2, that is 70 is the new base rate. So what will be the new base price? 500 into 70, that is 35,000. What will be the new amount of payment? 35,000 divided by 66. Why 66? That is the exchange rate. 530.3. So interesting part to notice, Indigo is paying less. Airbus is receiving more. I repeat the entire thing. Exchange rate is this. Deviating by 2 rupees from the lower boundary. So there is a profit. Assuming profit is shared by them equally, 71 minus 2 by 2, 70. So this is the new base rate. 500 to 70 is the new base price. How much Indigo will pay? 35,000 by 66, 530.30. So similarly, if it goes beyond the upper boundary of the neutral zone, say 76, so there is a loss. So how much is the loss? 2 rupees shared by them, assuming equally. So new base rate will be 71 plus 2 by 2, that is 72. New base price will be 500 to 72, that is 36,000. And how much it will be paid? 36,000 divided by 76, that is 473.68 million. So here interesting part is Indigo is also paying more. and Airbus is also receiving less. So that is how it is done. Any question? If it is not shared by them equally, assuming equally, suppose 75% will go to Indigo and 25% of the profit will go to Airbus. Now, it is very unlikely that Indigo will share a profit of 75% but share a loss of 25%. So the other party will not agree. So if you share a profit, if the profit and loss are shared equally, similarly, if you share a profit of 75%, you should also share a loss of 75%. Anyway, I'll show you one. So if the profit is shared 75% by Indigo, out of 2 rupees of profit, Indigo will get how much? 1.5. So new base rate will be 71 minus 1.5. Okay. So base price will be, so that will be 69.5. Base price will be 500 into 69.5. That is the amount Indigo will be paying. Okay. Question? Anybody? So Ankit, is it clear? Ajit Shukumar. Roll number 3D, you are there? Anyway, so now last question which we have is, which method would you suggest? That's our last question. Which of the hedging alternatives analyzed above would you recommend to Interglobe Aviation Limited? As I have told you, that is the nature of forward market hedge and money market hedge are same. The nature of forward market hedge and money market hedge are same. So out of these two, whichever is cheaper, you will accept that. So we have seen in this particular, in fact, in an ideal condition, the value of forward market hedge and money market hedge will be same. So in this particular problem, we have seen that the forward market hedge is cheaper than money market hedge. So we'll accept forward contract. Again, it is very difficult to choose a particular method or suggest a particular method. Here we have seen that is at 73 rupees, forward and option both are equally profitable. If the price is more than 73, forward is more profitable. Price is less than 73, option is more profitable. We have also seen that Indigo can write a call option at 72.5 and receive a premium of 400 million rupees. Okay, this is also seen, but we have also discussed that in that case, Indigo does not, Indigo does not reduce the risk. So it is there in the risk. Now, question is, if which one to select? Every company has a treasury division and they try to predict though it is a cost center, but everybody tries to make profit. So Indigo's treasury division will try to predict what could be the possible exchange rate after 1 year. Difficult to predict, but there are techniques with which you can try to predict. So if they find that it will be more than 73, so of course forward is more profitable. If the estimated price is less than 73, forward option can be more profitable. Suppose Indigo finds, the treasury division finds that the price will be around 72.5. Indigo can write an option also. So by writing an option, you receive a premium. So there are different alternatives which you have depending upon your perspective about the future exchange rate. Any question? Confusion? Anybody? Any question, confusion? Go to the next problem, huh? So this is a problem on payables. Next problem will be problem on receivables. So, but before I start the next problem, let me once again ask you, is this problem clear to everybody?
Yes, sir.
Good. So, right hedging strategy it is given. It is very difficult to recommend one particular hedging strategy as each method has its own limitations and advantage. Between forward market and money market hedge, IGL will choose forward market hedge as it is cheaper than the other and the nature of both the methods are same. But option contract or currency collar can become a better alternative depending upon the situation and IGL's expectations of the exchange rate after 1 year. Now there is another most but everybody why most of the Indian companies, most of the trades in the world are in forward contract. Most of the transactions are forward contract because that is the most popular. That is the most popular method all over the world. Okay, so that in India, so forward is the most popular one and most simple one. Huh. However, in India, there is a new product which is offered by banks to especially to MSMEs called zero cost option. Now, you must have seen in currency collar, we have bought one option and sold option, and we have our limits set, and of course, we have reduced the premium outgo. So, in a zero cost option, there will be a series of option which will be bought, and there will be a series of option which will be sold in order to make the total premium outgo zero. I repeat, in a zero cost option, we make the premium outgo to zero by buying and selling a series of options. However, when you make the premium outgo to zero, so naturally your range will also be reduced and it will be also like a forward contract, almost like a forward contract. So we have another problem on receivable, currency receivable. So read the problem also. Hindalco Industries Limited managing his US dollar receivable exposure. So Hindalco Industries Limited exports goods worth US dollar 100 million to Creso Limited, and the payment will be receivable 1 year from now. So in this case, Hindalco will be receiving $100 million 1 year from now. Spot rate 62.7410 to 62.7780. What does it mean? What does it mean? One year forward market, same thing. If you want to buy in the forward market, you have to pay 66.7983. If you sell in the forward market, you will get 66.7589. 1 year future market, same thing, 66.2110 if you buy, 66.1215 if you sell. Of course, future market, along with that, there are brokerages and there is margin money, so you have to pay interest on margin money. 1 year US dollar interest rate is 1.5% to 1.8%. What does it mean?
So when you are borrowing US dollars, you have to pay 1.8% interest, and when you are lending, you will get 1.5% interest.
Good. Similarly for Indian rupee, if you borrow, you have to pay 7.5%. If you deposit, it is 6.5%. So 1 year call option at a strike price of $1 is equal to 66.5 is trading at a premium of 1.85. So if you buy, you pay a premium of 1.85. If you sell, you receive a premium of 1.85 per dollar. So for $100 million, 1.85 into 100, that is 185 million rupees premium. Similarly, 1 year put option at a strike price of $1 is equal to 64.5 is trading at a premium of 1. Same thing. Premium will be 1 into 100. So first question is, what is the hedge value of Hindalco's receivable using a forward market hedge and a money market hedge? So forward market hedge, what will be the what action Hindalco will take? What will be Hindalco's action? Hindalco will be buying $100 million after 1 year or selling $100 million after 1 year. So if it sells $100 million in 1 year forward market, what will be the rate? 8983. Oh, sorry, 66.7589. So Hindalco can sell $100 million in the forward market at an exchange rate of $1 is equal to 66.7589. That means after 1 year, Hindalco will deliver $100 million to the buyer of the forward contract and receive 6675.89 million, irrespective of the exchange rate between dollar and rupee after 1 year. Any confusion? Any confusion?
Okay.
So next question is money market hedge. So how do you do money market hedge? If you remember correctly, last problem, we had a payable of euro. So we created a receivable of euro. How? We deposited euro for a period of 1 year. Some amount of euro for a period of 1 year where it became 500 million euro after 1 year at the prevailing rate of interest. In this case, what is happening? We have a receivable of $100 million. So in order to mitigate the risk or net the risk, what we need to do? We need to create a payable of $100 million. So how do you create a payable of $100 million? So you borrow dollar. So if you borrow dollar today for a period of 1 year, so after 1 year you have to repay dollar. How do you repay the dollar? The dollar which you are receiving from Hindalco will be utilized. Dollar which you are receiving from Creso Limited will be utilized to repay the loan. So today you borrow in such a way that you have to repay $100 million after 1 year. How do you do that? You will be receiving $100 million from Creso Limited that will be utilized to repay the loan of $100 million. Does it make sense? So how much you can borrow today in order to repay $100 million after 1 year? So if you borrow, rate of interest is 1.8%. Okay. So HAL can also hedge its dollar exposure by using money market hedge. So HAL has a receivable of $100 million after 1 year. So it needs to create a payable of equal amount by borrowing 100 divided by 1.018 million, which is equal to $98.2318 million at the rate of 1.8% for 1 year. Okay. So if you borrow $98.2318 million at the rate of 1.8% for 1 year, it will become $100 million after 1 year. Any question? So how do you repay this $100 million? Very simple. After 1 year, you are going to get $100 million from Hindalco, from Creso that will be using. Now, what do you do with $98.2318 million? You convert into INR. What will be the exchange rate? What will be the exchange rate?
So 62.7410.
Absolutely. Convert dollar into rupee means you sell dollar and buy rupee. So if you sell dollar, how much money you will be getting? 98.2318 into 62.7410, which is equal to 6163.1614 million rupees. So how much money you are getting? 6163.1614 million rupees you are getting. Now you are getting this money today. Okay? You are getting this money today. So invest this money in Indian market. So what is the rate of interest? 6.5% if you deposit Indian rupee. So invest this 6163.1614 million at the rate of, invest this rupee 6163.1614 million at the rate of 6.5%. So it will become 6563.7669 million. Is that clear? Does it make sense? Huh?
Yes, sir.
So after 1 year, you will be receiving, Hindalco will be receiving $100 million from Creso, which will be utilized to repay the loan. Because by that time, loan has also become $100 million. So how much you have actually? You have 6563.7669 million, which is the rupee deposit. Now basically what you are doing here, you are converting your dollar receivable to rupee receivable. Dollar receivable to rupee receivable. Whatever dollar you are receiving, that you are utilizing to repay the loan, and that loan is converted into Indian rupee. So this is money market hedge, and as I have told you, nature of money market hedge and forward market hedge is same. So in this case, if you have a receivable, the one where you will get more money, you will choose that. So in this case, we are getting more money in forward market hedge than money market hedge. Money market hedge, we are getting 6563.7679. Forward market hedge, we are getting 6675.89. So we'll go for forward market hedge. But in an ideal condition, as I have told you, that value of forward market hedge and money market hedge will be same. Is that clear? Question, confusion? Anybody?
No, sir.
So next one is a future contract. So what is the hedge value of Hindalco's limited receivable using a future contract? So tell me. So Hindalco has a receivable. So in order to mitigate the risk, it has to sell a future contract. What is the price? Right. So Hindalco can sell a future contract at an exchange rate of $1 is equal to 66.1215. So it will receive 6612.15 million after 1 year, though it is mostly settled in cash. Okay. And also it is an exchange traded product, so it is more secured, but you have to pay brokerage and there is margin money, so you have to bear the interest cost and margin money. So ultimately it will be more expensive than forward contract. Is that clear? Yes or no?
Yes, sir.
Next one is option. So you are given call option, you are given put option. Which one you will use? Bit fast.
So put option.
Buyer of a put option has the right to sell. Indigo has to sell. Okay. So Indigo will be buying a put option at a strike price of 64.5. That is what is given. And at a premium of 1 rupee per dollar. That means for $100 million, it will total pay a premium of 100 million rupees. Okay. Sorry. So Hindalco will buy a put option at a strike price of $1 is equal to 64.5 and pay a premium of 100 into 1, that is 101 million rupees. Okay. So if it does, then it will have the right to sell at 64.5 because buyer of a put option has the right to sell. So after 1 year, if the price is more than 64.5, it will not exercise its right. Why? Because it can sell it in the market at a higher price. However, if the price is less than 64.5, then it will exercise its right and sell it at 64.5. So in that case, how much money it will receive total? 64.5 into 100, that is 6450 million, but it has already paid a premium of 100. So 6450 minus 100. So its minimum amount receivable is 6450 million rupees minus 100. Now, but though at the end, if you exercise your right, you calculate what is the total amount, but premium paid is a sunk cost. So it will not affect your future decision. That is, whether you will exercise your right or not, that is not determined by the premium which you are paying. Okay. Question? Any question? Is that okay with everybody? Abhinav, 1D. Aditya Karmakar, 2D.
Yes, sir, it is clear.
So Aditya, after a long time, I called somebody's name and he is there. No, that's not with section D only, other sections also. Ajit Shukumar, 3D. Okay. Can you use a call option here? So if you write a call option, then you receive a premium of 185 million. How? 1.85 into 100, 185 million. So call option, Hindalco can also write a call option at a strike price of 66.5. That is the one which is given, and receive a premium of 100 into 1.85, that is 185 million. But in that case, the risk is not eliminated. If the price falls below 66.5, the buyer of the contract will not exercise his right. Why? Because he has the right to buy at 66.5, but not the obligation. So if the price is less than 66.5, he will buy it from the market. So Indigo has to sell at a lower price in the market. Similarly, if the price is more than 66.5, the buyer will exercise his right. Why? He has the right to buy at 66.5. If the market price is more, he will exercise his right and buy at a lower price. So in that case, what is happening? In that case, what is happening? Your risk is not eliminated, though you receive a premium of 185 million rupees. Okay? So it can only make up a portion of this loss by a premium of 185 million. It receives by writing the call option. By writing a call option, it is also limits its maximum receivable to 6650. You don't get more than that, because if the price is more than that, the buyer will exercise his right. So naturally, you don't get the benefit. So naturally, call option is not suggested. We can buying a put option is suggested. When you write an option, you actually do not eliminate your risk. So basic idea here is always remember that since the price is call option does not, writing an option does not eliminate the risk, that does not mean that nobody will write an option. I told you in the previous problem, that is the Treasury Division will try to predict the price. So if the price estimated is again near 66.5 and Indigo writes an option, it receives a premium of 185 million rupees. Make sense? Huh?
Yes, sir.
So what is the next question? At what exchange rate cost of option is just equal to the cost of forward market hedge? What is the cost of forward market hedge? 6675.89. We are talking about put option. So put option, you pay a premium of 100 million. So if the exchange rate is X, at exchange rate both are equally profitable. Okay. So at how much money you get at X exchange rate? 100 into X, but here you paid a premium. So premium will be deducted from your receivable. In the earlier case, premium was added with your payable, but in this case, you have a receivable, so premium will be deducted from your receivable. So 100 into X minus 100 million rupees, this must be equal to the forward price. I repeat, if the exchange rate at exchange rate X, if both of them are equal, so how much money you are realizing in option contract? 100 into X minus 100, Y minus 100, premium. This must be equal to the forward rate. So X is equal to 67.7589. So at 67.7589, both are equally profitable. Just tell me one thing. If the rate is more, which one is profitable? Forward or option? So suppose this is also, forward is also 66.5, option is also 66. Put option is at a strike price of, so say 64.5. Suppose this is also 64.5, this is also 64.5. Okay? I repeat, this is 64.5, this is also 64.5. Okay. So which one do you choose?
So forward.
Why?
Because in that case, we don't have to pay the premium.
So if the price is more, you choose one. If the price is less, you choose the other one. Got it? Yes or no? I repeat, at one price, we have decided at one price, this price, how much we have, how much you have calculated at an exchange rate of 67.7589, both are equally profitable. So if the price is more than this, you remember, you bought a put option. Forward, I repeat, forward, you don't pay a premium, but option you pay a premium. Okay? So you bought a put option. So when you buy a put option, you have the right to sell. So if the price is more, will you exercise your right? No? So put option is more profitable? Yes or no? So if the price is more, put option is more profitable. If the price is less, forward is more profitable. So if the $1 is less than this, forward contract is more profitable and vice versa. Is that clear? In our earlier example, earlier case, it was just opposite. Okay. Make sense? Proceed further. So same way, how can you construct a currency collar? Buying a put option and writing a call option. Okay? Buying a put option and writing a call option. Okay?
Yes, sir.
So HIL can construct a currency collar by buying a put option at a strike price of $1 is equal to 64.5 and writing a call option at a strike price of $1 is equal to 66.5. So interesting part here is, here when you are buying an option, you pay a premium of 1 rupee. When you are writing an option, you are receiving a premium of 1.5. So net premium received is 1.85 minus 1 into 100, that is 85 million rupees. So here you are receiving a net premium. In this particular example, when you are constructing the currency collar, you are receiving a net premium. Next is, what are the difference? Can anybody explain me this? So you have bought a put option at 64.5. You have written a call option at 66.5. Now you explain me at different prices how the price is that. Anybody? Anybody? Ankit, will you try? Please. So suppose the price is 64. What will be your decision on put option? So you have the right to sell at 64.5. Market price is 64. So if you sell it in the market, you get a price of 64. Whereas if you exercise your right, you can sell at 64.5. So you will be exercising your right. What about call option? Not exercised. Why? That person has the right to buy at 66.5. Market price is 64. So he can buy it from the market at a lower price. So you are exercising your right means you are selling at 64.5. So price you are paying is 64.5. Any question? If the price is 64.5, your decision is immaterial. Why your decision is immaterial? So both the places you get the same price. So if you exercise your right, you get 64.5. If you do not exercise your right, sell it in the market, there also you get 64.5. Call option will not be exercised. Why? Again, that person has the right to buy at 66.5. Market price is 64.5. So he will not exercise. So how much price you are going to pay? 64.5. Is that fine? If the price is 65, you don't exercise your right. Why? You have the right to sell at 64.5. Market price is more, that is 65. So will you exercise your right? Right. And get a higher price. What about call option? Will not be exercised? Right. So none of you are exercising. So what will happen? You have to sell it in the market. Price is at the market price 66. Okay. Yes or no? So at 66.5, you do not exercise your right on put option. Call option, it is immaterial. Why? If that person exercises his right, he can buy it from you at 66.5. If he does not exercise his right, still he can buy from the market at 66.5. Now you are not exercising your right. He is also not exercising your right. You have to buy it from the market at the prevailing market price, 66.5. If it is 67, you don't exercise your right, but he exercises his right. Why? He has the right to buy at 66.5. Market price is 67. So he exercises his right and you have to sell it to him at a price of 66.5. Is that clear? What is the last question? I believe risk sharing. Assuming a neutral zone of 65 to 67 per dollar and a base rate of 66 per dollar, show in detail how the two companies can share the risk. So they have decided, as I told you earlier also, it is not necessary that this base rate will be mean of this lower and upper boundary. Not necessary. So what will be the base rate and what will be the neutral zone, that will be decided by both the parties sitting together. Okay. And whether the risk will be shared by them equally or on some other ratios, that will also be decided. So in the book, there is one problem. Here there is only one range, 65 to 67. So in a book, you will see there is a problem with different range. With 65 to 67, this is the case. See, suppose the price is beyond 65, say 62, say 63, and here it is 70. What will be they have one range. If it is beyond that, there is another range. So in this way, there is a problem with different ranges. So let us solve this problem. So within an exchange rate of 65 and 67, how much money Hindalco will receive? So within a neutral zone of 65 to 67 and a base rate of 66, Hindalco will receive an amount equivalent to 100 into 66, that is 6,600 million rupees. Is that clear? So 6,600 million rupees Hindalco will be receiving. So how much, what is the maximum amount and minimum amount Creso will pay? 6,600 divided by 65, that is 101.5 million, or 6,600 divided by 67, that is 98.5. This is the maximum and minimum amount. If the exchange rate is 65.5, they will pay 6,600 divided by 65.5. It is 66.2, 6,600 divided by 66.2, and so on. Okay. If the exchange rate goes beyond the upper boundary or lower boundary of the neutral zone, contract will be reopened like the previous case also. So suppose it is 63. So it is deviating 2 rupees from the lower boundary of the neutral zone. Here there is a loss. Why there is a loss? Hindalco is receiving the foreign currency. So if the exchange rate if the rupee appreciates, in this case it is appreciating. If the rupee appreciates, so it is a loss for the exporter. So Hindalco will be losing. Okay. So the 2 rupees of loss, if it is shared by them equally, 1 rupee each. So new base rate will be 66 minus 2 by 2, that is 65. And what will be the new base price? 100 into 65, that is 6,500. So Hindalco is receiving less. Earlier it was receiving 6,600. Now it is receiving 6,500. And how much Creso is paying? 6,500 divided by 63, which is $103.17 million. So Hindalco is receiving less. Creso is also paying more. So both of them are sharing loss. What about profit? So if the Indian rupee depreciates, suppose depreciates to 69. So what is the profit? 2 rupees, 69 minus 67, 2 rupees. If it is shared by them equally, 2 by 2. So new base rate will be 66 plus 2 by 2, that is 67. And what will be the new base price? 100 into 67, that is 6,700 million rupees. So Creso Limited will pay an amount equal to 6,700 divided by 69, that is 97.1. So here interesting part, Hindalco is receiving more, Creso is also paying less. Any question? Anybody? So if at this moment, if I ask you that which is the best alternative, which alternative do you suggest? Answer is same like the previous one. It is very difficult to choose a particular method because each method has its own advantages and disadvantages. And again, the treasury division or, the company has a perspective, that is what could be the possible exchange rate, and accordingly, it can take a decision. Is that fine? If you have any question, fine. Otherwise, I'll start a new chapter. Okay. So before I start the chapter, let me tell you that the assignment is not yet uploaded. I was under the impression that you people, because like you people are receiving a lot of news is that you have to come on this day, that day and all. We are also receiving the same kind of mails and newses. So initially we thought if you come, we'll take a presentation. If you come to the campus and take a presentation, then later on we thought since we'll be coming late, so that is why you have a different kind of assignment. So somebody has to take the responsibility, because in the other section somebody has already taken the responsibility. You will be informed. That is, how many you have? Around 53, 54 students, no?
Sir, we have 57 students.
57.
Yes, sir.
If you have 57 students, 4 groups, 4 members per group, that means how many?
14
There
should
are
be made.
14 groups and one group will have 5 members. Doesn't matter. So if you make your group, somebody has to take the responsibility to make your group. So each group will be assigned a different case. So cases will be, I'll give you. So each group will be assigned a different case, and naturally you will have to write the case and upload in Campus 360. So what all you need to do, everything I will tell you. But for the time being, you just form the group. And normally what I do with you also, I'll do the same thing. Suppose you have 4 members in a group. Suppose 3 members say that member 4 has not worked. So then that member does not get any marks. Okay, so it's up to you. We also know that when it is a group assignment, everybody does not work. So that is why this is the thing. Anyway, make the group, will upload the assignment, and you will get time within which you can write and submit the assignment. So any other question, confusion before we start the new chapter?
I will mail you the website, like I'm the class representative, so I'll mail you the.
Very good. I was about to ask who is the class representative. So you make the group. So 4 member per group. Is that fine?
Yes,
so remember, this is what we have done is the most important chapter of our entire course. Managing transaction exposure. So we have done little bit of methods of translation exposure. What was translation exposure? If you remember correctly, that is, if you have a subsidiary in a foreign country, then at the end of the year, you convert the foreign country's assets and liabilities in your currency, in the consolidated balance sheet. So while doing that, due to exchange rate fluctuations, you can suffer a loss, or the value of the assets and liabilities can go down. So that is what is called translation exposure. What is transaction exposure? That is, as soon as you are entering into a transaction involving foreign currency, I repeat, as soon as you are entering into a transaction involving foreign currency, it is transaction exposure. Okay? I repeat, as soon as you are entering into a transaction. So in these 2 cases, what happened? Hindalco entered into a transaction where transaction means it exported goods. Similarly, in the earlier case, Indigo also is importing something, so for which it is also entered into a transaction involving foreign currency. So there is a risk. Okay. So, but for the other 2 parties, like in case of Indigo, Airbus does not have a risk because Airbus is receiving its own currency. Anyway, so translation and transaction is done. We are left with operating exposure. So what is an operating exposure? I told you. Can you see the slide? Measuring and managing economic exposure. So I told you what is economic exposure. That is, exchange rate change, exchange rate fluctuations can alter your future cash flows. And we have also discussed economic exposure is divided into 2 parts. One is called transaction exposure, which you have done in detail, and one is called operating exposures. Now, operating exposures, for that you do not need any subsidiary in a foreign country, neither you need a transaction which involves foreign currency. So basic idea of operating exposure is, as soon as you are exposed to foreign competition. If you remember correctly, the first day of our class, we talked about the tea shop owner opposite to IIFT. So that time we discussed that though that man he procures everything locally, but he still is exposed to foreign competition. How? For he is still affected by exchange rate fluctuation. Why? So if Indian rupee depreciates, what happens? We say from 74.5, if it becomes 75.5, so we will be ending up paying more money for buying crude oil. And if that happens, if we pay more money to buy crude oil, then domestic price of petrol and diesel will also go up. So if the domestic price of petrol and diesel goes up, then our cost of production will also go up. So that person, that tea shop owner, will end up paying more money as transportation cost. Apart from that, whatever products he is selling, so naturally he is also exposed to foreign competition. Say for example, he sells tea, so naturally our competitors are Sri Lanka and Sri Lanka and Kenya. Okay, so there are two major competitors in the international market. So if if exchange rate fluctuates, so if Indian rupee becomes Indian rupee appreciates, so their product will become cheaper in India and our product will become expensive in their country. Okay, so naturally, supply demand will be disrupted. Okay, so everybody is exposed to operating exposure as soon as you are exposed to foreign competition. If you are not, see, for example, most of what we find is the tea which he sells is probably not affected by the demand and supply of tea in the foreign market. Now it depends upon a lot of things. Suppose exchange rate changes and India starts exporting more tea. So what will happen in the domestic market? The price of tea will go up. Demand for tea will go up, so price of tea will go up. So if India starts exporting more tea. So basic idea here is more or less you are exposed to foreign competition always, but it happens more as soon as you are exposed to foreign competition directly. And that happens when with a product, with anything. Okay, let us see. So economic exposure focuses on the impact of currency fluctuations on firm's value, the most important aspect of foreign exchange risk management, which you have talked about. So incorporate expectations about the risk into all basic decisions of the firm. All. So economic exposure, as I have told you, divided into transaction exposure and operating exposure. So it arises because currency fluctuations alter companies' future revenues and expenses. So we talked about this in detail. Transaction exposure. Now here we'll be talking about only operating exposure. So to measure operating exposure, it requires a longer term perspective. Cost and price competitiveness could be affected by exchange rate changes. What do you mean by cost and price changes? So one is you are manufacturing by importing your material. So when you import your material, remember, when you import your material, if Indian rupee depreciates, your cost of production will go up. But when you are exporting your finished product, if Indian rupee depreciates, your revenue will go up. Make sense? Yes or no? So two are different things. One is if Indian rupee depreciates, it affects the importer, but it benefits the exporter and vice versa. So which one you are doing? If you are doing both, you are affected in a different way. So that you need to keep in mind. So accordingly, you have to manage your risk. So operating exposure begins the moment a firm starts to invest in a market subject to foreign competition or in sourcing goods or inputs abroad. Okay. Just 1 minute. Just 1 minute. The moment a firm starts to invest in a market subject to foreign competition or insourcing goods or inputs, so it is not necessary that you have to only sell goods. It is possible that you are importing your raw material. So again, if you invest in other countries, what are the places where you can invest? One is new product development. Understand this? New product development, you are developing a new product. Does it require any explanation? New product development. You are investing in a foreign market for developing a new product. So exchange rate changes will definitely alter your revenues. Yes or no? A distribution network, a brand name development, marketing, you are supplying in the foreign market, you are developing a production facilities. So these are the things which you are doing in the foreign market. Yes or no?
Yes.
So any idea how they are going to affect? Suppose you are supplying foreign, you have a foreign supply contract. So if exchange rate, if Indian currency depreciates, it will benefit you, or you will be a loser. So when you are exporter, so suppose you are developing a new product in a foreign market, or you are making a distribution network or a brand name development. So these are the things which you do in the new market. So if your currency depreciates, naturally you will be benefited, because when you bring the profit to your country, naturally it will be more. But at the same time, at the time of investment, your cost will go up. How? Because when you are investing in a foreign country, suppose you have decided you will be needing $100 million to invest. So today $1 is equal to 75 rupees. So if you want to buy $100 million, it will be 75 into 100, 7,500 million rupees. But suppose from 75 it becomes 76. So what will be your investment? 7,600 million rupees. So it has both sides. So when you make an investment in these countries, so if you naturally your investment cost will go up if the exchange rate fluctuates. Any question, confusion? Any question, confusion? Here you are actually not exporting or not importing. You are setting up facilities in a different country. Question, confusion? So understand real exchange rate and nominal exchange rate. You understand nominal rate and real rate interest. Nominal rate is equal to real rate plus inflation, or if you deduct inflation from nominal rate, you get the real rate. Similarly, there is one nominal exchange rate and one real exchange rate. So is basically adjusted for price changes. So here also there is a question of inflation. So from nominal exchange rate, if you deduct the inflation part, you get the real exchange rate. So in fact, if you remember correctly, when we had done those parity conditions, when we tried to we predicted the forward rate on the basis of real exchange rate, we also on the basis of nominal exchange rate. So when we had done on the basis of real interest rate, or also on the basis of nominal interest rate. When you are done on the basis of real interest rate, that becomes actually real exchange rate. Okay. So one needs to see which one is changing. That is, if nominal rates change with an equal price change, no alteration to cash flows. If the nominal rates changes with an equal price change, no alteration to cash flows. That means your real rate is not changing. However, if real rates change, it causes relative price change and changes in purchasing power. So naturally, if real exchange rate changes, if your currency depreciates, then your purchasing power will change. Similarly, if your currency appreciates, your purchasing power will also change, but in your favor. Question, confusion? Question, confusion? No sound from your side. What do I understand?
No, sir. No question.
Are you understanding? Shatyapriya,
Yes.
can you explain me this? No, sir. Because what I can make out from your, there are different kinds of silence. Huh? What I can make out that, it's not very clear to you people. So if the price level changes, it is changing in your country, so exchange rate is also changing. So you don't lose the, your purchasing power remains same. But when the real exchange rate is changing, so naturally it is changing. Basically, if the real interest rate changes, naturally your real exchange rate also changes. Okay. I think we'll call it a day here because not getting good response from your side. Next class.
Okay.
That also does not sound good. So from when you were saying, okay, sir, that also means that you are not understanding. Good. So then I should continue. Go to the next
Yes.
slide.
Yes,
So
sir.
till this slide we have done implications. So next slide is a decline in the real value of almost same thing, a decline in the real value of a currency. Okay, I'm not talking about nominal value of the currency. A decline in the real value of a currency makes exports and import competitive goods more competitive. So if your currency value, real value of your currency goes down, so your export will become you will lose your export competitiveness. Yes or no? And the goods which are import competing, the goods which you are importing, okay, suppose you are importing a particular goods. So whatever, suppose you are importing particular goods, in the sense your import becomes cheaper. So naturally the goods which are available in the market, they will become competitive. See, Indian tea, which is available in the market. So if my import cost goes down, I can bring the foreign tea at a lower price. So Indian tea will face a competition against the foreign tea. Yes or no? So when my real value of my currency goes down, not only my export becomes difficult, the goods for which I have a import substitute, that is the goods, say for example Indian tea and foreign tea. Now my foreign tea I can import at a lower price, so they will be available in the country at a lower price. So my Indian tea will be costly compared to those. Similarly, an appreciating currency makes imports and export competitive goods more competitive. Okay, so you lose so if your currency appreciates, so naturally what happens? Your imports become cheaper. And what happened to your export competitive goods? Goods which you are exporting, so naturally they become difficult. Your export will be expensive if your currency appreciates. So export competitive goods will be more competitive. So that is what we discuss. So if there is a change in the real value of a currency. Sure, but before you ask your doubt, just remind me. Next class we'll start from we have completed till slide number 9. Okay. Yeah. Doubt. The goods for which there is an import substitution, or which you can import, and the goods which are available and competing with that import. Okay. As I've told you, Indian tea, you can import Sri Lankan tea. Okay. So if the value of the real value of the currency goes down, then you can export and import becomes costly. So your Indian tea is competitive, becomes competitive, and vice versa. So call it a day. So next class, remind me. Okay. Okay. Then. Bye.
Thank you, sir.
Thank you.